All right. Hello, everybody. My name is Jackson Pino. I am Minneapolis area Realtors Public Affairs Manager, and I am going to walk you through our October residential market update over the data we found in the month of September. Let's jump right in. Our agenda today, we're going to go over those monthly housing charts of September, and we're going to have a quick introduction into the year-to-date numbers as well as part of that. And then we'll jump into an emerging topic that our research director, David, and I have been playing around with. And I want to at least give you guys a sneak peek to a report that we'll be releasing in the next couple days around community rings, think like urban, first ring suburbs, second ring suburbs, that sort of thing. We'll dive into some market segmentation after that, and then zoom out to the wider housing market. If we have some time, we'll answer any questions that you have. If we don't have any questions, and we still have a bit of time left, might even try something like, looking at InfoSparks and taking questions on InfoSparks if we need to. But that's the agenda for today. I hope you all are ready. Let's also take a moment and acknowledge something that we were just a few days late for the scheduling of this webinar, but it is Hispanic Heritage Month. We celebrated it at MAR along with our Institute Affinity Group, NAREP. And in the spirit of always wanting to have a quote or a mantra to focus around, to theme around, I found a great quote from Ellen Ochoa. She was the first Hispanic woman to go to space as a member of the Space Shuttle Discovery. She spent over 41 days in space in her total career as an astronaut, and went on to become director of the Johnson Space Center. After that, she was vice chair of the National Science Board. And she, when asked, how what was a huge contributing factor to her success, her determination? She said, the opportunities I had were a result of having a good educational background. Education is what allows you to stand out. And I think that can be put into many contexts, but particularly here, I mean, the whole reason why we hold these webinars is to make sure that our research team is educated, that you, the people watching this, are educated, and therefore your clients are educated on the important changes on what's going on in the Twin Cities real estate market, right? So with that in mind, we're going to jump into our market update, looking at the September housing market. So starting things off with demand, that driver of the market in so many critical ways, right? Looking at September closed sales year over year, you can see that we have had 4 years of a downwards trend. And in fact, I'm going to bring in a little pen here to kind of start things off to really make sure that we're talking about this in an appropriate context. I want to make sure we're using the phrase correction, and I'll tell you why. Yes, we are down 16% from last year, and last year was down 22% from the year prior. I get that, and I'm sure many of you practitioners here, the realtors in this space, are feeling that shift. But I want to propose something to you. This line right here, let's see if I can draw it. There we go. From 2015 to 2019, particularly in September, we were relatively flat, stable, at around or just above 5,000 homes sold, closed sales per month, right? And then if you'll follow the trajectory, we went up and then we went down, okay? If you were to keep that flat, admittedly, we had some outlier years here, 2020, 2021, right? Let's extend that horizontal, that flat just above 5,000 homes sold. You can see, ideally, if we're going to come out of this in 2024, we're seeing corrections here. That triangle above the line needed to be compensated for. The triangle below the line is that compensation. So I'm going to use the phrase correction. You can choose whatever terminology you want, but I wanted to take a moment on this first slide to just set some terms and context set for you all, right? I hope that is clear as I continue throughout this presentation to talk about context setting and correction in the appropriate way. So with that in mind, yes, we were seeing a correction. We've seen a correction for the past 2 years now, and we are now just above 4,000 homes sold. Closed sales. Pending sales, that leading indicator for what we believe will be closed sales for the following month, right? Is a pretty similar and just as stark correction as what we're seeing here. 3,600 homes went under purchase agreements in the month of September in 2023. 7.3% down from last year. And last year was where we took the big hit, that almost 30% decline in pending sales. That is where we were seeing the lion's share of softening buyer activity. And ideally, we will eventually come out of this and we will hit a new normal. Where that new normal is, only experiencing it will tell us, right? So we know what this looks like. We've seen this for a while, that softening buyer activity, right? And who knows that better than anybody else? The flip side of that coin. September new listings show, again, yep, that correction. We're seeing that same correction that we saw before, right? But that's because today's sellers need to be next week or next month's buyers, right? And buyers have two things that are incentivizing them not necessarily to list as often as they were before. They were incentivized in 2020 and 2021 because of amazing mortgage interest rates that they could get on their next home. Well, they have those great mortgage interest rates now, right? And they're staying in their home because who wants to give up a 3% interest rate on a 30-year mortgage right now, right? We see them right now at 5,700, 5.5% down from last year at just over 6,000. Yes, the other part of that is if there is dwindling, there is a dwindling demand on the other side of this, they're not necessarily excited of saying like, oh, let me go buy that home. Sure, there's less competition, right? But another driver of this is that there's this anticipation that with, an economic future that wasn't as frenzied as it was in 2020 and 2021, that home prices would go down. And what are we seeing lately? Home prices have not gone down. The growth in home prices has diminishing returns on that growth, right? We are seeing 2.4% increase from last year, which was 6.3% increase from the year before. And then everything prior to that, between 2020, 2021, almost double digits, if not double digits. We're not seeing that major price growth anymore. We are seeing diminishing returns or diminishing growth, but it's still positive here in September. Couple months prior, if you've been coming to these regularly, you'll know that we were flat or we were marginally down. Luckily, for just the stability of our economy, we aren't going down. There may have been some fears of that happening, but it looks like that's not necessarily the case. For the record, we'll say we're at $371,000 as a median sales price for the 16-county metro area. But let's take a look at that year-over-year change in better detail. Love this chart. Absolutely love this chart. This is that year-over-year change in median sales price. We're taking the absolute numbers out of it now. We're looking at that relative change. So that way we can laser focus in on what that diminishing return looks like. And you can see it right here. We had negative, this is what the chart will look like when home prices go down. This is what happened in 2008, 2009. right? We're not seeing all this red here. We're seeing one. And what we were viewing in that diminishing price growth is that these blue bars are getting closer to zero, but they're not going negative, save for 1 month this year. That lowly 1 month in June, maybe. David, if you want to put it in the chat, I think it was in June, but that's my memory right there. Not that I have this scripted. But overall, our fears of having another true downturn in terms of median sales price, we weren't seeing that. This means, ideally, that the Federal Reserve was doing their job appropriately. They were controlling that run on inflation without having negative backlash on one of the more vital parts of the economy, real estate. So let's jump into September's percent of original list price received. That is a great measure, as we all know, of indicating the negotiation between buyers and sellers, right? And you can see that sellers definitely had leverage in 2020, 2021, and we have gone down since that to having more 99, almost 100% of sales being at original list price. That is similar to what we were seeing pre-pandemic. 2017, 18, 19 was even a little less. This month of September in 2023, we were at 99.3% of homes sold. The homes sold at 99.3% of original list price. That's close, right? So another indicator that I am starting to enjoy more and more is the use of cumulative days on market, median CDOM, as we like to say, to describe the pace of the market. How fast are units moving in and out of our MLS? And you can see here, there's been a general trend for years since 2014 of the market just moving faster and faster and faster until we hit a critically fast speed in 2021. And then that correction, we're starting to see the correction again. And if you look at the final 4 years, it looks relatively flat within that scope, 15, 19, 12, 17, not far off, right? We're starting to see a normalizing pattern of the speed of the market at this speed. It is still fast relative to what we were seeing years ago. 17, half of all homes listed were under contract in under 17 days. The other half over, sure, but half, that's impressively fast compared to what we were seeing a decade ago. That's that new normal that we need to start thinking about. And speaking of changes in the past decade, I think it's only appropriate that we bring in inventory one more time to just get an understanding of a market driver that really hasn't changed in a way that you would think would lead to, more or less competition in the marketplace, closer to a buyer's market, right? We know that the frenzy's over, the heights are no longer here of 2021 or 2022. But you know what stayed relatively the same throughout those 4 years? End of month inventory. These are the counts of homes that were left on the market at the end of the day on September 30th in each of these given years. And you can see for the past 4 years, we've been hovering around what, 9.8, within 1,000 units of each other, which is a fairly tight tolerance compared to what we saw the 4 years prior at 15,000 to 13,000. So why are we seeing, why aren't we seeing inventory go up if demand is so low, right? The reality of it is we're in a strong seller's market. Homes are not being built at the rate that they were specifically, pre housing market crisis in 2006, 2007. That was arguably unsustainable home building, right? But we've talk about a decades-long correction. We've underbuilt for nigh on a generation now, right? And this is still a fundamental some may call it an issue. Others may just be more neutral about saying it is a dynamic of the marketplace. And because of the, let's use the phrase stability over the past 4 years and how short our inventory is, we have limited growth in terms of September's month supply of inventory. Yes, we have grown out of 1.6 month supply of inventory in September of 2021 and gone to 2.5-ish month supply of inventory in last September 2023, right? That's an 18% growth from last year, but that's still a strong seller's market. We all are familiar with the idea that a 4 to 6 month supply of inventory is more academically accurate in what we would call a balanced market between sellers and buyers. This, what we are currently in, is not a balanced market. We still are so short on inventory that even though demand has gone down, our month supply of inventory has only gone up so much. Think about that in context, right? Gregory, I see your question here, or more of a request. It would be neat to see median price graph overlaid with the inventory. And you know what, Greg? David, thank you for the emojis. Gregory, I'll do you a solid. How about this? Come next month, we'll make that overlay for you. Okay, that is straightforward enough. Let's try it out. Let's see if that's insightful. Bring yourself, bring your friends. Let's see what that new chart looks like. Okay, let's jump into that quarterly update. And with that in mind, I think we all kind of know what this is going to look like, especially if you've been here for a while. I don't want this to be a doom and gloom session of we're down, right? We know we're going to be down, but let's also keep in mind that this is the first 3 quarters of the year, right? This is going to give us a fairly rough indication of how the full year plays out. This is the best quarterly by quarterly guess that we can make, right? There is still opportunity for some traction to be gained for each of these metrics, but I just want us to set that tone now and be prepared so that way there aren't big surprises for us, for your clients towards the end of the year when we're reporting these sorts of numbers, right? So with that in mind, let's kind of skim through this and we'll be at about the halfway point. We can dive on to other subjects. So closed sales, September year to date. So again, the 3 out of 4 financial quarters for the year. And we're at 34,000 homes closed on in 2023 so far. Yes, that is 20.5% down from the 43,000 that we were at this time last year. That trend right there, and you can kind of see that there was a higher equilibrium in 2017 through 2019. We didn't really see the major effect in 2020, nor in 2021, but a higher compensation, as I've been defining it, through 2022 and 2023. Keep that in mind as we're looking at these. I won't, belabor the point on that again, right? New listings, very interesting, right? We just saw that flat stability of 66 to 62,000 homes supplied to the market by this time, year over year over year, and then the decrease in the supply of new homes continued in 2022, and now we are at 48,000 just over in 2023, which is 15.5% down from last year's 57,000. Median sales price, again, we see a bit of diminishing price growth at Again, median sales price through the entire year being $371,000, 1.5% up from the 365,000 last year. And again, we're definitely not anticipating 12.5% growth anytime soon. Ideally, we want to get back to that 5, 6, 7% price growth. That's good linear stable growth at what I'm seeing in 2015 through 2019. That's something that would be a great indicator for the health of our economy, right? Average percent of original list price received, uh, similar to what we were seeing in the monthly. September was a good representative of the 3 financial quarters so far in this regard. Yes, pre 2021, we were looking at just under 100% of original list price received at sales. In 2021, 2022, that was more 2.5% over, 2% over, and now we are correcting again back to just under 100%. Days on market, again, similar idea here, that leveling off in the past 4 years and an increase relatively in the past 3. We're up 42-ish% from 17, half of all homes sold in 17 days or fewer throughout the entirety of the year. That includes, the rush of May and June, as well as the more quiet months of January and February. So keep that in mind, right? All in all, a pretty fast year. Not as fast as 2021, I get it, but still fast. All right. Gonna jump into the Twin Cities metro rings. And this is something more that I want to highlight as a way to freshen things up for everybody. I know we love the charts. The charts are great. I want to make sure that we don't just focus only on the charts for you all. We're trying to inspire you as realtors to get curious about different ways to view the market, different emerging opportunities that might be out there. This is one of those that I think is important to dabble around with. I'm gonna say right now, we have not had enough time, the months that it would take to dive in deep and get really nitty gritty with all this stuff. But that's okay. This is an emerging concept of looking at the market in just a different way. And I want to throw it to you, the faithful market focused realtors that you are. And I want to get your feedback on these concepts, whether or not they're useful for you as a realtor, and how we could use this in better ways. So by all means, throw information into the chat, questions, comments, ideas on how we could use this, because it's only going to help us improve our services to you and your services to your clients. So with that in mind, let's talk about community designations. These are community designations. What are community designations, Jackson? I hear you asking your computer right now. Think of this, broad brushstrokes here, as a way for the Metropolitan Council to categorize different different groupings of the metro that aren't usually by, city, county, whether or not it's a residential area or a commercial area, but more about land use planning, about do we define this as something that is well developed, semi-developed, developed in a very specific way, or not developed at all, right? And some of these terms you're pretty familiar with, the idea of like urban, suburban, right? Some of these you may not have ever heard before, like diversified rural, a rural center. What's the difference between rural residential, a rural center, and diversified rural? I'm not going to go into huge detail because they did a lot better at reporting this in a link in the description of these slides that I'm happy to share with you than I ever could in the 30 minutes or so that I have left. But let's take the rough ideas here of this from urban edge, which I hope including suburban and suburban edge are kind of self-explanatory. And we'll dabble into the more rural designations in context, um, and play around with this in the context of being a realtor and someone who buys and sells homes on behalf of clients in these areas. There are meaningful difference in the market dynamics along these grouping categories, right? Selling a home in Plymouth here in blue as a suburban home might be different than selling a home in Edina or in St. Louis Park or in Hopkins, because those are they're in their own categories as well. And whether or not you see this as, you know, useful because you work in one, you might just be working in the rural, you might just be working in the urban, but you might be straddling multiple of these. And I want to encourage you to know and understand the difference of these. Not going to take up more than 10 minutes of this. I want to make sure that we have ideas to play around with here. So, with this in mind, let's take a look at MLS data that is divided up by these categories. Most of these are going to be line charts. We'll go through these at fairly high level, okay? So, supply, new listings, right? Divided out by these categories tells a pretty interesting story, I think, in terms of the growth of the suburban edge as a major supplier in our monthly housing market, right? You can see back in 2007 to 2010, that fading off of the bubble here, urban housing was the highest supplier. You know, the homes, if they were being listed to the housing market, more often than not, the leader in that was going to be urban or suburban. With the edges, think of it like a pizza of hot market, not as hot market, hot market, not as hot market, as you went out from the metro center, right? Now, in from 2012 on, that urban supply has been dwindling. And what has come to replace it? That suburban edge. And remind you, that outer blue area here has come to replace, in terms of supply, there are more homes being sold on the market. Yes, some of that is new construction, absolutely. Others is that there might be higher turnover in those areas, right? That's super interesting to me. To see that rise of that light blue line as a major competitor over time in terms of supply. So let's flip the other side and take a look at closed sales, right? Similar story, and you'll notice across both of these, there's two groupings, two major groupings, right? The rural areas, yes, are a lot lower because there are fewer homes, fewer people living there, right? That's not necessarily that interesting right now. We could dive into just what the rural homes look like if we wanted to, but I wanted to keep it high level here, right? One grouping of rural, one grouping of more urban-ish, right? And a very cool story, again, the trading off of these lines is showing me that prior to 2010, the uh, the urban, or sorry, from 2010 onward, the gap between urban and urban edge had been widening between that and the suburban and suburban edge in terms of demand, buyer activity. More people were seeking out homes in the suburbs for nearly a decade. And you can see that expanse happening, what, 2018-ish, where we were really seeing a wide gap of buyer activity between the suburbs in dark blue and the urban communities in that darker orange, right? But look at what happened once 2021 came about. Yes, a downturn, each of those sharp drop-offs that you're seeing there. But look at the tightness of the gap between the urban communities and the suburban communities. That to me shows that there's a potential emerging opportunity should the urban communities regain that top spot that they had back in 2009. That may be something that we want to capitalize on, right? And trying to play around with these ideas for emerging opportunities for you. And I hope you can see that too as a practitioner in this space. One more, and then we'll move on to market segmentation. The idea of median sales price, right? The price of these homes by community designation. And there seems to be an inverse here, right? Where the rural communities were way down at the bottom because there were fewer homes to sell, right? We couldn't even really see the variation in them. Now that everything's equal, we're talking dollars and cents here. uh, they're on par, and in fact, in many cases, exceeding the median sales price of some of the other community designations. Hint as to why that might be the case: home size and land size, right? Like just it's straight up more value. They might be proportionally, if we controlled for things like land and home size, the suburbs might be higher than the rural areas, but we haven't controlled for that here yet. That's something we could look into if you all are interested in it. Throw it in the chat. Happy to jump on any ideas like we had with Gregory earlier on, right? But in particular, I want to pull out two ideas here. Diversified rural, and I'll explain what that is now for those of you who were eager. Think of that as the cities in the areas in dark green, that not the darkest of green, that's agriculture, but these middle green areas, the bright kind of lime color that we got going on. They are just outside of rural centers, you know. They're in the rural center is in yellow. Think of that as like a small town that's got a bunch of stoplights. They got a Hy-Vee, that sort of thing. Um, but they're away from that hustle and bustle of a rural center. They have bigger lots. There are people who are able to put in a lot of money. I think of these lime green areas, they have 11 out of the top 50 homes in median sales price. And that is why they are rocking up to above $600,000 for a median sales price in those homes collectively. There's variation in the rural communities, no doubt. There's variation in all of these, but on the whole, they stand out because of that. And look how much the median sales price of those cities grew since the onset of the pandemic. That's a rocket ship right there. And in the inverse, agricultural here in gray. That was the darker green, by the way, in the map. Agricultural communities, on the other hand, saw the only meaningful decrease in median sales price out of all of these community designations. Now, I just told you twice earlier in this presentation that on the whole, we didn't see a decrease in sales price, right? Doesn't look like that's the case in the agricultural communities. Now, if I were a realtor who worked in those communities, I'd probably be feeling that a lot more and I'd want answers. Well, looks like we might be able to try to find a way to provide some answers. So if you want answers for things like this, let us know. That's all I got for these. I hope you find this interesting. If you do, we're going to be writing a blog about it. We're in the draft phase of that right now. Would love to get some insight on that once that's released. With this done, let's move into some of the more traditional market segmentation that we always talk about, right? Things like townhouse condos. And most of these are going to be in terms of market share, so we can just see the relative increase, right? So townhouse condo market share is up to 28% of all homes, of all sales in the Twin Cities in the month of September. That's That's something we have noticed for the past couple months, that 2023 seems to be the year of a higher market share of townhouse condo, even though everything is going down, right? It's because it seems like the single family market has been hit harder than the townhouse condo market. And it seems to be the case here. New construction is also up, and it's up year over year for 2 straight years now, 2021, 2022, and 2023. We're up to 12% of new construction was uh, new construction was 12% of all sales. And moving into the idea of beds, a rough indicator for homes square footage size, that's a little bit more easy to wrap your head around, right? Than just straight total finished square feet. Um, More beds, please. Here's the percentage of all sales that had 4+ bedrooms. And as you can see, in 2020, we had a bit of a uptick to 42% of all homes were 4+ bedrooms. And while we have established a new equilibrium above 38%-ish, it has been dwindling in recent years, down from 42% to 41%, then 41%, and then 40%. So we're down a percent. Cash deals as a percentage of all sales. This was something that we highlighted as our key topic of focus last month, if you remember. Cash sales are up to being 16.5% of all sales in the Twin Cities, and that's up 1.5 or 1.6% from last year. So cash deals as a sale of the luxury, or in this case, million plus category, that is where we're seeing a major increase of 34% of all sales. That's up a ton, right? David and I were talking about this, and I think, David, you mentioned this to the appraisers. There seems to be two worlds of it, right? There's lots of cash for under 200,000, homes that are sold for under 250,000. Ideas around that could be investors, right? And then there's plenty of cash for the million plus. Even I would go as low as to say the above 750,000. That's your higher net worth luxury buyers, right? And then everything in the middle, that's financed, right? That's the new world that we're in right now, and it's not that it's never happened. That's happened before. It's that it's becoming more concentrated on the ends, that cash deal likelihood. So be aware of that. We got about 15 minutes or so. So let's take 5 minutes to dive into the wider economy, just to give you some context there. And then I'll answer any questions that you have with about 10 minutes or so remaining. So the wider economy. This is information pulled from, oh, this is not August. I apologize. I had a little mix up and I had to write this slide at the very last minute. This is September's housing report. And this is showing the unit sales of existing homes, their percentage change from September of last year to September of this year. The absolute value numbers, I don't think it's a fair comparison of comparing the West to the Midwest, the South to the Northeast, and so on. But the percentage change, I think, is appropriate, right? Northeast down 16.7%, Midwest down 18.4%, South down the least at just under 12%, and the West just under 20% down in unit sales of existing homes. That is down across the board, as we have seen, and we're definitely still feeling that throughout the Twin Cities as well, right? Again, this is September home prices. we are relatively up. Nobody is down. Midwest is at 4.7% up in median home sales prices. The Northeast is just slightly beating us at 5.2% above. The South is just 3% above last year's median home sales price, and the West is marginally up at just under 2% increase from September of last year. This is 30-year fixed mortgage rate average in the United States from our St. Louis Federal Reserve. This shows us that we are at an average for that 30-year fixed mortgage rate of 7.6%. That is a decade's high average for the 30-year mortgage, right? You can see here on the chart from the Federal Reserve that it's been high. Not as high as it always has historically been, but as high as it has been in a decade. And I will say that there have been some conversations. I had a conversation with our good old friend, Pat Paulson. Even yesterday, he was seeing reports of 8%. I'm not saying I haven't seen it. Maybe you have, David, if you see it in the chats. I go with the more conservative St. Louis Federal Reserve here because their source is Freddie Mac. But this is definitely a big impact for buyers, right? We know this. I'm in my final 10 minutes now, and I said that I would save some time for questions. With that, I wanna end things again with another inspiring quote because I really couldn't choose between the two. This is Puerto Rican professional baseball player Roberto Clemente, who played 18 seasons of the MLB. He's a member of the National Baseball Hall of Fame and involved in charity work throughout his life. Roberto actually died on a plane crash at the age of 38 early in his life while en route to deliver aid victims to a Nicaraguan earthquake. And he had this great quote, actually, asked why he does his charity work that he does that eventually took his life. He said, if you have a chance to accomplish something that will make things better for people coming behind you, and you don't do that, you're wasting your time on this earth. That's big stuff, right? But I think we can take a nugget of that here and say, we all came to this webinar for a reason. We want to be able to help people in our own ways. You're helping your clients with this information. I'm helping you help your clients with this information. I hope you find that meaningful and you take advantage of that information and you help the people that you are here to serve as a realtor. And with that, I'm done with my presentation. We're not necessarily out of time, but I am happy to take questions. Tom, you got a great question in the beginning. Many economists are predicting a recession. Are many economists predicting a recession during 2024? Oh, you say it as a statement. Tom, I'm going to challenge you a little bit on that. What I've been seeing is that it's not when we will be coming out of the downturn overall, it's when. It's either going to be more immediate or it'll take, a couple of months, i.e. like a good portion of the year. I think it would be a little too dramatic to say that we're predicting another recession. I would have to see some pretty convincing evidence to believe that there's going to be more damage than what has already happened, provided we don't have another COVID-19 pandemic. I think the Federal Reserve, as we were seeing with a lot of the charts, has had a pretty reasonable response to controlling run-on inflation in our economy, at least in the real estate economy. Any other additional questions for me? Megan, yes, is it still a strong seller's market? Yes, it is. The Easiest way to determine that is just looking at month supply of inventory. We're at, what did I say here? 2.5 months supply of inventory. That is still a very strong seller's market, not a huge difference in practical terms. It feels different maybe, but it is definitely a strong seller's market, definitely. How's our jobs market metro wide? I haven't looked at job of unemployment in the Twin Cities for this month. Um, so I can't give you an immediate response on that. I know just generally we've been at pretty low unemployment, and unless there's been some major, continuation of, domestic car manufacturers calling for strikes or something, like I don't know if there is much to be said that's different from just record low unemployment rate. Uh, if David or anybody else wants to jump in with that, that's all I've heard. And Megan, just saying thank you for another great webinar. Well, thank you. I appreciate everybody contributing to this. Um, if you do have the time and you're still on, please, Alicia put a request in the chat to fill out our survey monkey. I really do want to make sure we get positive feedback for the things we do well, and constructive feedback for the things that we need to improve on. So please take that survey. Would love to hear back from you. And if we don't have anything else, I will stop screen sharing there, and I will say thank you all. And please join us again for our November monthly housing market webinar on the third Thursday of the month. All right, take care, everybody.